Every night, while you're sleeping, 12 people in a room in Manhattan decide what money is worth. Not symbolically, literally. They set a number. And by morning, that number has already changed mortgage rates in Sydney, moved bond prices in Frankfurt, shifted the value of every pension fund in Japan, and quietly added or subtracted thousands of dollars from your retirement account. You've never met these people, you didn't vote for them, and most of the time you don't even know their names. But they control something called the federal funds rate. And if you want to understand why your rent keeps climbing, why tech stocks collapsed in 2022, why your savings account suddenly started paying real interest for the first time in 15 years, and why the entire global economy seems to hold its breath 8 times a year, you need to understand this one number. Because this isn't just about America anymore. This is about how a single interest rate in New York became the operating system for every financial market on Earth. Let's start with a basic question that sounds stupid until you really think about it. What is an interest rate? At its core, it's the price of borrowing money, the cost of using someone else's cash today and paying them back tomorrow. But here's where it gets strange. In most markets, prices are set by supply and demand. Buyers and sellers negotiate. The invisible hand does its thing. Not here. The federal funds rate, the most important interest rate in the world, is set by a committee, the Federal Open Market Committee, 12 people, 7 governors of the Federal Reserve, plus 5 rotating presidents from regional Fed banks. They meet 8 times a year in a building on Constitution Avenue in Washington. They look at employment data, inflation numbers, economic forecasts. They debate, and then they vote. And when they vote, they don't just change one number. They change the fundamental cost of money itself. Now, technically, the federal funds rate is the rate at which banks lend to each other overnight. That's it, just banks shuffling reserves back and forth to meet regulatory requirements. Sounds boring, almost trivial, but here's where the leverage kicks in. Because every other interest rate in America is built on top of this one number. Treasury yields, corporate bonds, auto loans, credit cards, mortgages, student debt, all of it references the federal funds rate as a baseline. When the Fed raises rates, borrowing gets more expensive across the board. Businesses delay expansion, consumers pull back on big purchases, the economy cools. When the Fed cuts rates, the opposite happens. Money becomes cheap, debt becomes attractive, asset prices rise, people feel wealthy, so they spend. This is the thermostat theory of monetary policy. Too hot? Raise rates. Too cold? Lower them. Simple enough. Except the thermostat is connected to every house on the planet. Here's the part that doesn't get enough attention. The US dollar isn't just America's currency, it's the world's reserve currency. About 60% of all foreign exchange reserves held by central banks are denominated in dollars. Half of all international trade is invoiced in dollars. The vast majority of global debt, including debt issued by countries that have nothing to do with America, is priced in dollars. So when the Federal Reserve raises interest rates, it doesn't just affect Americans, it strengthens the dollar against almost every other currency on Earth. And when the dollar strengthens, something brutal happens to emerging markets. Countries like Argentina, Turkey, Egypt, they've borrowed heavily in dollars. When the dollar rises, their debts become more expensive to repay in local currency terms. Their imports cost more. Inflation spikes. Capital flees to the safety of U.S. assets. In 2022, the Fed raised rates at the fastest pace in 40 years. Within months, the Sri Lankan government collapsed. Pakistan needed an emergency IMF bailout. The Japanese yen fell to levels not seen since the 1990s. None of these countries did anything wrong. They just got caught in the wake of decisions made by 12 people in Washington who were focused entirely on American inflation. This is the uncomfortable math beneath the system. The Fed has a domestic mandate, but its power is global. Let's go deeper. The federal funds rate doesn't just influence borrowing costs, it reprices the future. Every financial asset is theoretically worth the sum of its future cash flows, discounted back to today. The discount rate, the number that determines how much future money is worth right now, is derived from interest rates. When rates are near zero, future earnings are almost as valuable as present earnings. This is why tech stocks with no profits but huge growth projections dominated the 2010s. Investors were willing to pay enormous premiums for cash flows that wouldn't arrive for a decade. But when rates rise, that math reverses. Suddenly, a dollar 10 years from now is worth significantly less today. High growth stocks collapse, bonds issued at lower rates lose value, real estate priced on the assumption of cheap mortgages starts to wobble. This is why 2022 was so violent for portfolios. The Fed didn't break anything, it just changed the discount rate. And when you change the discount rate, you change the value of everything. Now here's where the skepticism enters. The Fed presents itself as a scientific institution, data-driven, measured, above politics. But look at the track record. In 2021, the Fed called inflation transitory. They kept rates near zero while prices surged. By the time they acted, inflation hit 9%, the highest in 40 years. In 2008, the Fed didn't see the housing crisis coming until it had already detonated. In the late 1990s, the Fed kept rates low while a massive stock bubble inflated and popped. The pattern is consistent. The Fed is often late. They overshoot, they undershoot. They spend years cleaning up messes they helped create. And yet, markets hang on every word. Traders parse every press conference for hints. A single adjective change in a Fed statement can move billions of dollars in seconds. We've built a system where 12 people have more immediate influence over the global economy than any president, any parliament, any international body. And they're guessing. Educated guessing, sure, but guessing. Zoom out for a moment. The federal funds rate is just one lever, but it's connected to a machine that now encompasses every asset class, every border, every household with a mortgage or a retirement account. When that lever moves, it doesn't ask for permission, it doesn't negotiate, it simply reprices the world. And the people moving it are accountable to no electorate. They're appointed, not elected. Their meetings are closed. Their models are proprietary. Their mistakes are absorbed by everyone else. This isn't a conspiracy. It's just the architecture we built. A system where American monetary policy is, by default, global monetary policy. So the next time the Fed meets and the headlines focus on whether they'll hike or hold or cut, remember what's actually happening. A small group of people is deciding the cost of money for 8 billion humans. And the strangest part? We've all just agreed to let them. The question no one seems to ask is what happens when the rest of the world stops agreeing.